days are getting shorter and windscreens are freezing over, which must mean it's time for the AJ Bell Passive Funds third quarter review. Japan and the US were the standout performers over the last 3 months, up 7% and 9% respectively. Stock indices in other regions were all grouped together, with returns ranging from -1% to +1%. Bond markets had a much tougher time, as both the Bank of England and the Fed in the US increased interest rates. Gilts fell by around 2%. In December last year, Trump pushed through reforms of the US taxation system. The tax paid by US companies on profits has been slashed from 35% to 21%. The tax cut provides a one-off permanent boost of over 20% to after-tax profits earned in the US. The majority of profits made by US companies are generated in their own country. This means that the overall profits of companies within the S&P 500 index will increase by between 15 and 20%. The S&P 500 index was up 9% over the last 3 months, bringing the total return over the last year to 21%. This means that although the US stock market seems to have raced ahead of other regions, it is somewhat justified by the higher cash generated due to these cuts. The trade-off is this could lead to a large hole in the US government's budget. If this is not offset by higher economic growth, it may lead to trouble down the line. We are watching closely. Japan is the largest stock market in the world, after the US, but often overlooked by UK investors. Abe, the current Japanese Prime Minister, was elected back in September 2012. He brought sweeping reforms into Japan, known as his Three Arrows policy, and this has led to strong performance of the stock markets. In fact, when looking at returns in local currency, it is the best performing market since Abe's election, even beating the US. However, earlier this year, Japanese stock markets struggled as Abe and his associates were embroiled in several scandals, and it was feared that his reign may come to an end. He faced a vote of no confidence and a leadership challenge. He has managed to come out the other side unscathed and was re-elected as PM on the 20th of September. This has led to a strong performance, with the Nikkei 225 up 7% over the last 3 months. Just as the quarter started, the Brexit negotiations got serious. On the 12th of July, the Tories published what is known as the Chequers Plan. This provided a proposed blueprint for the UK's relationship with the EU. This plan proved controversial, both sides of the channel, and has led to turbulence, especially in currency markets. However, hope has emerged as chief EU negotiator Michel Barnier indicated that a compromise could still be reached before the deadline. The pound originally fell against the US dollar as the Chequers Plan was rejected. However, it has recovered somewhat in September, ending the quarter just 1% lower. In truth, no one knows how the negotiations will end. In the case of a hard Brexit, we would expect the pound to weaken and we would favour international investments, whereas a good conclusion would lead to a better performance of UK domestic stocks. We are pleased with how the funds have performed over the last 3 months, all of them up over the period, despite gilts falling. The funds have now passed through their first anniversary, giving us a 1-year track record. Over the last 12 months, we have seen increasing returns as we move up the risk scale, ranging from just over 3% for the cautious fund to just below 9% for adventurous. The recently launched Global Growth Fund is still in its early stages, but delivered a positive return over the last 3 months. I'd like to take this chance to remind you that from the 1st of January next year, our standard custody charge will apply to all investments in the AJ Bell passive funds, though we'll continue to waive our standard online dealing charge when you buy the funds. If you want to learn more, you'll find the details on the charges and rates page on our website. Whilst we're speaking of charges, I'm happy to report that we've been able to reduce the ongoing charge figure, also known as the OCF, which you pay for some of the passive funds as they've grown. The OCF is always capped at 0.5%. but 3 of the 6 passive funds already boast an OCF lower than this, the lowest being the Balance Fund at just 0.42%. At each quarter end, it appears to be the same story. Share prices have in general moved upwards, whereas bonds have struggled as interest rates increase across the globe. We see no reason for this trend to stop, at least in the short term. However, as we highlighted at the end of the last quarter, stock markets are now up over 300% since the end of the global financial crisis in 2008. A Trump tweet, a hard Brexit, or an unexpected conflict could be enough to bring the current bull market to an end. For now, we believe the best place is still in shares. However, we remain ready to adjust the funds if we see signs of weakness, or indeed a major global event affects the long-term prospect of the global economy. As ever, we would urge you to do your own research to ensure that any investment you select is appropriate to your attitude to risk and your financial circumstances and objectives. If you are unsure about any of this, please speak to a financial advisor. Thank you very much for watching.